Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we have ourselves a market in transition today. Let's take a look at what we have for what is an interesting week in markets, setting up for, of course, the NFP report on Friday, which will not have a market reaction because it'll be the Good Friday holiday. And so there's not going to be liquidity in markets writ large. We're going to have closures in Europe. We're going to have closures in Asia. Of course, closures in the U.S. Much of Europe and Asia will remain closed going into next week because they take Easter Monday off as well. So we have here a situation where probably the most important piece of economic data in the sort of post-SVB, latest U.S. Fed prognostications period here over the past 1 to 2 weeks, obscured by illiquidity and market closures, and its response delayed. And so quite a lot seems to be happening in the run-up to that data to set the stage. And so let's take a look at what we've seen so far, and then let's see if we can figure out what that means going into what may be the last 48 hours of trade, really, for this this story, and maybe the last opportunity for markets to really find some momentum before the lull finally settles, the holiday lull. So the question, of course, in the wake of the data that we just saw over the past day here is inflation finally ending? Are we finally on a path that's sustainable to get inflation down to the Fed's objective? And if so, is that actually good news? Should the markets be happy about that? So let's explore. We have today the key number that we were previewing yesterday, the job openings number. That's the green line you see there. You can see that with that number coming out, we have a result that gives us the lowest job openings since really the beginning of 2021, give or take. So we're really looking at a very meaningful decline here. The expectation was that we would have 10.5 million as the number here, and clearly we ended up with something lower at 9.9. That's the weakest that we've seen this since May of 2021, and of course June 2021 is when the Fed started on its rate hike crusade. It didn't start raising rates yet, but that was the point where it seemed to throw in the towel on the inflation is transitory idea and really start to set the stage for what became the aggressive tightening cycle of 2022. So you can see here that with the rise post-COVID in job openings, you've likewise seen a run-up in near-term inflation expectations. That's the 2-year break-even there, the difference between nominal and real bond yields, which gives you that inflation adjustment that takes you from a nominal to a real bond yield and gives you the expectation baked into the bond market for what inflation is going to be in 2 years' time, so right within the Fed's policy window. And you can see it's come off, but it's still relatively elevated at 2.6%. Today, though, you can see clearly a downtick from 2.7 yesterday to 2.6 today, thanks to this data. And you can see here what the market reaction was. So there's the data coming out. I'm using GMT here for the timeline because it doesn't have daylight savings time, so it's a little bit more consistent. So 1400 GMT is what we're looking at here. That's where the data comes out. And you can see the immediate response. Go up is up. So in other words, those things that don't yield very much or nothing at all are up. The U.S. 10-year yield is down. You can see that's the loser on the day here. Then stocks, interestingly, down, and the dollar off a bit. This is, needless to say, a very interesting response and something that clashes quite a bit with the dynamics we'd become used to in markets. Since that middle of 2021, amid the speculation on what the Fed is going to do, and really the focus of what will they do at the next meeting, how much will they telegraph for the meeting thereafter, very kind of shorter term thinking and very narrow thinking about what is actually occurring. Ever since that became, for the better part of a year and a half now, the dominant story, what we've seen is that when rate hike odds rise, the dollar tends to do well. This is because the yield appeal of owning a currency with higher rates was acting as a buoying element. That, of course, makes sense if and we've talked about this at length before, but if you have a situation where interest rates are rising, that means that borrowing in that currency is more expensive, but lending in that currency is more lucrative. And so owning that currency confers a greater capacity for income as rates rise. So when interest rates go up, the currency that is attached to the central bank doing the hiking typically rises. Not surprising then that we saw the dollar strengthen around rate hike expectations. Those things that do attract for themselves, like gold, like the yen, they tend to decline. Stocks didn't like rate hikes because, of course, that's a higher hurdle rate on investment, making it more difficult for companies to hire, making it more difficult for companies to expand, making it more expensive to conduct all manner of economic activity from the household level to the business level to the investment level. And that, of course, is something that is a negative draft on earnings. So not surprising that stocks didn't like it. Yields loved it, needless to say, because the entire yield structure is essentially an extrapolation of what the Fed does at the Fed funds level. What the Fed funds rate is effectively the shortest term interest rate to lend to the most qualified borrower. So it is really the lowest that interest rates can go. That lowest interest rate in terms of time is, of course, overnight. And that most qualified borrower is the U.S. government. Because the plausibility of it defaulting is so ludicrously small that it passes for safety. Now, does that mean it's impossible for the U.S. government to default? Of course not. Nothing is impossible. But the likelihood is so infinitesimally small in the sort of grand scheme of things that it is a borrower that commands very low interest rates. Now, as you begin to look at other borrowers, let's say a company, some corporation, an individual, a fund, etc., as large or as well established as they may be, they are not as impervious to default as the US government. And so you start to see interest rates rise to reflect the risk. As timelines go out from overnight to 3 months, let's say, to 2 years, to 5 years, to 10 years, interest rates rise again because you have a situation where the more time passes, the more things could happen to hamper the ability of the borrower to repay. So again, you pay for that additional risk. But the baseline for all of the interest rate complex in all of its many forms across the economy is the Fed overnight rate. From this, all things stem, as it were. And so if you're in an environment where that's rising, that's going to have broad-based consequences for everything that you're looking at and everything that's sensitive to the cost of money, which of course is absolutely everything. So with that in mind, this reaction seems a bit inconsistent because you do have a stronger gold, you do have a stronger yen as a consequence of these numbers because they ostensibly speak to those rate hike odds being more so contained, to yields being more so contained, and clearly yields are down here. What's different is that the S&P did not capitalize. That whereas over the past year and a half, rate hike odds going down would be good news for the S&P because all those hurdles that we've just talked about from higher rates would have been seen as perhaps less severe than otherwise. That did not happen here. In fact, the S&P lost more ground than did the dollar. So, and of course, part of that is liquidity. The dollar is much more liquid in sum total. Not surely the UUP ETF that we have here, but of course, that's not what we mean when we say the dollar. We're talking about the direction of the currency as a whole. So, why does this matter? Well, and why are we getting this response? Well, let's explore. So we've looked at this chart before. We know that it seems to be that the Fed's efforts and other central banks' efforts at tightening monetary policy have been effective at curtailing inflation to some extent at the cost of curtailing growth. So the dark line here, total global trade volume, as a kind of higher frequency proxy for overall global economic activity. And you can see that there was a brisk recovery post-COVID that got the ceiling put in as the Fed started to hike. And you can see as that growth rolls over, so too does inflation. You see here the two benchmark U.S. measures of inflation, the PCE and the CPI, rising up with volumes and then reversing lower with them also. But of course, the problem is that gets us to inflation of 5 to 6%, not inflation at 2%, which is what the Fed is looking to do. And this is where we start focusing on numbers like the job openings number that we just saw. We just discussed yesterday that this is really the pivot in the U.S. labor force supply versus demand story. And you can see here that supply is substantially undershooting demand here, where demand is the number of people currently employed plus job openings, those people that companies want to be employed. And supply is the labor force, so those people currently employed and those looking for work. So the big disconnect here because, of course, those people already in work exist in both of these lines. The disconnect is between those people looking and the number of openings. So if the number of openings comes in, then the gap between supply and demand narrows. The implications of that are necessarily disinflationary. And you can see that as we've had this gap widen, so too inflation has increased. What we have here in the bars is actually the distance between these two lines here made into a single difference. And so what you see is that during COVID, of course, you have a surge in labor supply as relative to demand. There's not much demand. The global economy is effectively closed, and a bunch of people are out of work. As those people come back to work, and indeed as the supply-demand balance flips, you get inflation. And so this is the longer-term, stickier part, because, of course, wages don't adjust down after you negotiate them at a certain level, unless you have layoffs. This is the part of the story that the Fed has been the most worried about. This is the part you can't fix by mending supply chains. You can't fix by all of the various reconvergence efforts on reopening after COVID, China being the last big holdout, now also reopening that we've seen. And so this is why this stuff matters. Because if, in fact, we start to get cooling in the labor market that a softer jobs openings picture would give us, then this part of the inflation story starts to fade away. And if it does, maybe then you do enable a move into that 2% area. The next big story over the next 24 hours then that we're going to be looking at is going to be the ISM service sector report. This is, of course, critically important because the service sector accounts for 3/4 of employment and economic activity in the U.S. economy. It is overwhelmingly the driving force of demand. And the expectation, as you can see there in the orange bar on the bottom, the overall index is in the yellow bars. The expected number for tomorrow is 54.5. That's the orange bar at the bottom. The expectation is that we are going to see a bit of cooling, but not much. And as you can see, going into this announcement, robust growth in new orders, an upturn in employment, and an inflation picture that's cooling but still very elevated at 65.6. This is, of course, an indicator that works in the logic of PMIs. So 50 is the center line, above 50 is growth, under 50 is contraction. The faster growth comes with movement further above 50. So the higher you go, the faster the expansion. And of course, ditto on the other side. The lower you go, the faster the contraction. So distance away from 50 confers speed in either direction. So you can see that at 65.6, you're looking at a price picture that is quite high relative to 50, even if it is lower relative to where it's been. And the expectation for the overall number is that we're going to get a modest downtick, but nothing dramatic. Now, this matters because, of course, that price component is a major input into the inflation story because this is such a dominant part of the U.S. economy. So you can see that with about a 2-month lag, that ISM service sector index tends to lead core PCE inflation, which is, of course, the Fed's singular reference point. This is the number that they really want to focus on, and which now sits uncomfortably in the 4 to 5% range. If we could get this services component heading lower, we could ostensibly then also see more progression toward a core PCE, much more in line with what the Fed is looking for, which is give or take 2%, much closer to where we were in 2017 and through, let's say, the first half of 2018. We shifted down a little bit closer to 1 thereafter, and of course, during COVID, inflation fell off a cliff along with everything else as economic activity ground to a halt. Now, leading into this data, we see that overall U.S. economic data continues to look very buoyant relative to expectations and still tends to outperform relative to baseline forecasts. But we have seemingly turned a bit of a corner. So you can see here that the most recent outcomes have become softer. Still, the tendency is a positive one, but some kind of a shift may be afoot. We also saw in the manufacturing side of this story, which understandably has been a laggard through this entire cycle. Nevertheless, as a leading indicator here, it did give us a substantially negative lead. So you can see sub 50 readings across the major components. And of course, the overall index at 46.3 is the lowest it's been since May of 2020, which is the depths of the COVID recession. So we're looking at a situation then where the leading indicators seem to be suggesting a vulnerability, in a sense that maybe this dynamic has room to continue. Maybe we're going to get to the next important step in this story. Now, the outcome for all of this has, of course, been a significant shift in the yield curve. And you can see that going into this period, again, looking back at this, from February onward, U.S. economic data was actually increasingly performing better than expected. And the margin by which it was doing it seemed to be expanding in parallel. So it wasn't just getting better, it was getting better by a wider margin. And that gave us this expansion in the yield curve, which you see here in the dotted line marked before the SVB collapse. And you can see that envisioned a path for rates whereby the peak was at around 5.5, and we'd still be well north of 5 into early next year. The picture now is very different. We're looking to stay where we are currently. It looks like through about the next 6 months. And then come October, November, there's no Fed policy announcement in October, but right around that period, you can see we dip below 4.75. And so we end up then in the next layer of the Fed rate structure, the next sort of stair step down from the current 4.75 to 5 range to the next increment, the 4.5 to 4.75 range. So you can see 6 months from here, we're looking at 4.6. And from there, accelerating rate cuts. What's interesting here is that the curve, even with worries about SVB signature and banking crisis contagion seemingly easing, we have a yield curve that's moving inward, especially for the 1-year 2-year, 3-year view. And what this is telling you is perhaps why the S&P didn't like this. That this is not about the environment being generally good if only we could get the Fed out of the way of risky assets. If only we could contain the banking crisis. If only nothing went terribly south in China or terribly south between Russia and the Ukraine as relative to where it is already. This suggests that the markets are starting to catch a whiff of recession in a much more potent way than before. And it is the weight of economic data at this point that's pushing this curve inward. So if we look at the overall picture here, we can see a mere 12 basis points out of 25 baked into the market for the May meeting. So the odds of a hike are now just 49%, less than even. From there, stasis in June, stasis in July, rate cut by September. So it looks like we're looking at already a graduating story on the rate cuts front. Down 28, 29 basis points in September as relative to now, down at least 50 come December, with maybe that second rate cut coming as soon as November. You can see at this point in the number of rate hikes cuts column there, the one just to the right of the date column, 1.92 in November, which essentially says one cut as relative to now and 92% chance of a second. The December number, 2 cuts, so that cut is already in there, and 65% chance of a third. So in the implied rate delta column, by December, we're 66 basis points lower than currently. So more than 50 and almost 75. Come January, we get to 75, and we start to flirt with the possibility of a full percentage point decline. So looking at the landscape, it appears as though rate hike odds now aren't coming off because we had a banking shakeup, and if only we were to contain it, we're back to our regularly scheduled sort of programming. On the contrary, it seems like the economic data itself is starting to warn markets. And of course, this sets us up for that jobs report that we mentioned at the top of the show. You can see here expectations are for the payrolls number to come in to 240. So that would be toward the bottom of the recent range. Jobless rate to hold steady at 3.6. If we get disappointments on the service sector ISM, in particular the employment component, like we did for JOLTS job openings, the probability that we get a soft employment report, which then significantly colors price action through much of next week, given the holiday shutdowns, will go up. And we're going to be looking for that NFP number to really give a very risk-off tone to things. And from a tradable perspective, the question, of course, becomes, well, how do you express that, and what is that likely to do? And we saw the U.S. dollar, again, weaken today, some of that yield-based support going away. But that doesn't seem to have a whole lot of legs in it. Because indeed, rate expectations were already shaken out of the forecast by the SVB situation. It is only now that we are starting to see economic data conveniently catch up as the next catalyst. So although the dollar clearly still had some reflexive selling to do as rate hike odds came in today, thanks to that JOLTS data and yields fell, the move was relatively stayed as relative to what we saw elsewhere. So maybe if we get further confirmation, there is less of that conviction. On the other hand, we can see here from my favorite analytical tool for the dollar smile. This is something developed by Steve and Jen and company, and something we come back to quite a lot here on Macro Money. What we see here is that the dollar tends to do well. The y-axis here is the value of the dollar. The x-axis is the U.S. GDP spread with the rest of the G7, other developed economies. So you can see that when the U.S. economy does poorly, which is the whiff of recession that we're catching now, the dollar tends to do well because you tend to get risk aversion and a cashing out into the most liquid form of cash that there is. This is why these notions about the U.S. dollar's demise and replacement with some sort of a ruble Brazilian real composite ostensibly are just the most ludicrous prognostications you might imagine. In my mind, there is simply nothing that's even comparably liquid, and so could replace the dollar in its role as the vehicle to transact across borders internationally, the medium of exchange, bar none, for commerce. Because of that unrivaled liquidity, when you get risk aversion, you will typically see people cashing out into dollars. And so the upshot for all of this may well be not so much dollar weakness as a dollar transition, and ultimately dollar strength as a consequence of what we're looking at here in the next several days. If, of course, this dynamic carries through and we really are looking at inflation having been effectively curbed and the economy starting to truly reflect the price of doing that, it could be more than a few days and quite a bit longer still. With that, this has been Macro Money for today, Tuesday, April the 4th. We'll be back tomorrow to talk in greater detail about what ISM numbers actually do and how that sets us up for the jobs report on Friday and what all of this looks like into that and in the wake of what we'd already seen by that point. Macro Money is here every week, Monday through Thursday, right after overtime with our friend Chris Vecchio, head of futures and Forex here at tastylive. I'm also on with Chris for Futures Power Hour on Fridays, and with Tom and Tony for First Call on Sundays. Outside of those shows, you can catch me opining either on the tastylive blog or via Twitter at Ilya Spivak. Thanks very much for joining. Good luck out there. Speak to you guys tomorrow. Godspeed.